Good day, my students. It is a great pleasure getting across to you once more. We're looking at accounting ratios, and this is a topic from financial accounting. Before we go ahead and discuss this particular topic, I implore you to get all the necessary materials and things that you need for this particular class, like your note, your jotter, your biro, and any other thing that will help you and support you during this particular period. Before we go ahead and explain in details, we are going to look at the objectives. And what are the objectives of studying accounting ratios? The first objective that is expected to be achieved is that as learners, you should be able to define ratios, write short notes on each of them, and calculate some of these ratios each time you are asked to do that. By the way, what do you understand by ratios? And what is the meaning of ratio to you as an individual? You've come across a topic on ratios in your mathematics. And what is that telling you? It is simply showing you the relationship existing between two figures. In other words, when we say ratios, we are simply referring to the relationship existing between two figures. It is an instrument used in the interpretation of financial statements. It serves as a medium for comparing different items in the final accounts. It helps in interpreting financial statements, for example, like the balance sheet, the trading profit and loss account, and so on and so forth. It serves as a medium of comparing different items in the final account. So, from the information provided in the books of account, with ratios, it is possible to compare the performance of different items. For example, the performance in terms of profit, performance in terms of the share price, the performance in terms of incomes, and the performance in terms of the capital that's employed, and so on and so forth. The first one that we're looking at is profitability ratio. So when we say profitability ratio, it means it is a ratio that has to do with the profit that is made at a particular operating period. In other words, it measures the profit earned over the period in relation to the capital employed at the end of the year. That is, it is a relationship between the profit and the capital employed. So if you want to find the profitability ratio, that is profitability ratio, so how do you determine it? So it has to be the ratio between the profit that is made or earned divided by the capital employed during the year. Gross profit percentage. The next one we are looking at is the gross profit percentage. We've discussed about the gross profit, and we said that gross profit is determined by subtracting the cost of goods sold from sales. So eventually, that relationship is one that gives us the gross profit. So gross profit percentage here is simply the ratio or the relationship between the gross profit that is obtained or that is generated and the turnover or the sales times 100%. That is when you've known the gross profit and you are given the sales or the turnover. So for you to determine the gross profit percentage, so it will just be gross profit divided by the turnover times 100%. The next one is net profit percentage. Net profit is the profit that is made after the deduction of the expenses. And the net profit percentage shows whether or not the running expenses are in proportion to the amount of trade or sales for that particular period. So it shows the ratio between net profit and sales multiplied by 100%. So that is what gives us the net profit percentage. In addition, we have what we refer to as returns on capital employed. This is the amount or profit that is made during a particular period in relation to the capital that has been committed or employed. So this ratio gives us returns on capital employed. And to get the exact value, this is multiplied by 100 as it is expected or supposed to be in percentage. So when we have the profit that is obtained or that is earned during a particular period, then we divide this by capital employed and then we multiply by 100%. So this helps the management in measuring our efficiency in using assets. Then capital employed is taken to be the total assets, that is the total sum of the fixed assets and the current assets. Turnover ratio. The turnover ratio is relationship between the sales and capital employed times 100%. It reveals how the company is able to use assets to make sales or to generate sales. Low rate shows the company may not be generating enough volume of business activities, while a high rate implies that the company is actually making a lot of sales, and as such, so more sales, so that we bring in more profit, so we should give more returns on the capital that is employed. We equally have current ratio or working capital ratio. Current ratio or working capital ratio simply refers to the ratio between the current assets and the current liabilities. The current asset consists of some items like cash in hand, cash in bank, stock, prepaid amounts, and so on and so forth. The current liabilities could be overdraft, could be creditors, or could be accruals. So all these constitute what we refer to as current liabilities. And this ratio shows the strength of the working capital and the level of solvency of the business or the company. It reveals how quickly the creditors' claims can be met. That is, if the creditors want the business to pay them immediately. So this one will enable or will show whether the business is able to meet such demands. We also have what we refer to as the acid test ratio or liquidity ratio, or we can also refer to it as liquid ratio. So, and this is simply determined by subtracting the stock from the current assets and then dividing by the current liabilities. This one provides a better measurement of the firm's solvency. That is, whether the firm is able to meet its immediate obligations or not. So this one is better to assess the company or the business, whether it's able to meet its immediate demands from creditors or from suppliers. We equally have rate of stock turnover. Rate of stock turnover is the ratio between the cost of goods sold and the average stock. And to determine the average stock, to determine the cost of goods sold, so it is equal to the opening stock plus purchases minus closing stock. That's what is going to give us the cost of goods sold. While the average stock is the addition of the opening stock to the closing stock and then dividing by 2. So that is what is going to give us the average stock. So finally, to get the rate of stock turnover, so it's going to be the ratio between the cost of goods sold and the average stock. So when the average of the opening stock and the closing stock is obtained, then it is used in dividing the cost of goods sold, and that will give us rate of stock turnover. This shows the number of times the stock or the business the stock was actually sold out. So it shows the number of times the stock was actually sold out. The next one we have is the stock on current assets. The stock is the quantity of goods kept or maintained at a particular period of time in the store or in the warehouse. And the stock on current assets ratio is the ratio between the stock and the other current assets. Stock itself is part of the current asset, but in this case, we want to find out the relationship or the ratio between stock alone on its own and the other current assets multiplied by 100%. That will give us the stock on current asset ratio. It shows the importance of stock as a percentage of current assets. So we want to see what is the percentage of the current assets that is part of stock. We also have debtors ratio. The debtors ratio shows the relationship between the debtors and the credit sales. That is, sales that were made and without having received the payment. And then the debtors are those who that are actually owing us or owing the business. So when debtors is divided by credit sales, multiplied by 100%. So that is what is going to give us the debtors ratio. And this gives the average credit period given to customers. So it reveals or shows the average credit period that is given to the customers or the customers of the business. So when the period is long, then it's a sign that the company is having poor credit control. But if it is small, then it shows the business is having a good credit control. Then we have creditors ratio. The creditors ratio is the ratio between the creditors value or amount divided by the credit purchases. That is, the volume of the credit purchases is used in dividing the value of creditors and multiply by 365 days. And this shows the average credit period enjoyed from suppliers. We also have investment ratio. This is used by the investors to evaluate shares of quoted companies. That is, we want to find out whether the shares of quoted companies, whether they are good investment opportunities, whether they can actually commit funds or money into such shares. And it is determined with this particular relationship. Price earning ratio is equals to quoted price of a share over earnings per share. Quoted price of a share over earnings per share. That is the first investment ratio. That is the first one that is determined. It shows the relationship. The first one that is determined is referred to as price earning ratio, and it is determined by dividing the quoted price of a share by the earnings per share. Then the second one is dividend yield. That is the second investment ratio that is normally determined. Dividend yield is equal to dividend per share all over share price. That is the dividend that is payable to each of the shares over the price of each share, then multiply by 100. It indicates yield on ordinary shares if profit were divided. That is, if the profit made is actually divided, so it shows what should have gone to each of the shares or each unit of share. We equally have dividend cover. So this is the profit. This is determined by the ratio between the profit after tax or total dividends, profit after tax over total dividends, or earnings per share over dividend per share. So it could be either of the two. It could be profit after tax divided by total dividends, or earnings per share divided by dividend per share. And this one indicates the extent to which profit is plowed back into the business. And when we say plow back, it means whether the profit or the income that is earned by the business is actually reinvested in the business. Assignment. You are given the assignment below, and you are expected to try your hands on it. You are given this information from the books of Fire Enterprises, and you are expected to answer the questions that follow. You are given sales to be 45,000 naira, opening stock 20,000 naira, closing stock 30,000 naira, expenses 15,000 naira, fixed assets 40,000 naira, debtors 10,000 naira, creditors 5,000 naira, and purchases 25,000 naira. You are expected to determine A, cost of goods sold, B, the net profit, C, the current ratio, D, working capital, E, gross profit percentage, F, net profit percentage, G, rate of stock turnover. Reference materials. For further readings and information, you can lay your hands on Simplified and Amplified Accounting, Financial Accounting for Senior Secondary School by Femi Longe et al., published by Longe Publishers. Or you can look at Business Accounting for West Africa by Omuya Geo. It could be book 1, or you can check some part of book 2 also. And it is produced or it is published by Learn Africa. Thank you for your time.